Hello, my name is Jawad Ahmed Fareed, and in our final and closing session on using value at risk, we will take a look at how value at risk tools and the work that we've done for value at risk can be used as far as allocating and calculating different limits are concerned. In today's session, we will take a look at stop loss limits, we'll take a look at PSR or pre-settlement risk limits, and we'll take a look at margin haircuts for bonds. The hope is that by the time we're done with this session, you would have a fair idea of how the work done for value at risk can be used for determining optimal levels for both stop loss, PSR, and margin requirements for bond portfolios. The primary question here is not so much what is an ideal and optimal level of limits, but more how do these levels change with changing volatilities in today's markets. Um, a prerequisite for this session is my assumption is that you've already done the work that has been covered in the quant crash course, starting from a review of both volatility, value at risk, capital, and capital attribution, and that you also completed the value at risk course, the course that we completed just before this session, where we physically built a value at risk spreadsheet using data for three currencies and three commodities, namely the Japanese yen, the Australian dollar, the British pound, and then on the commodity side, WTI, gold, and natural gas. The portfolio numbers that you see here are driven from the same sheet that was completed in the previous course, and the calculations that we're using assume that you have access to the specific sheet. Right. So let's start with the first question. Let's take a look at stop loss and let's see how the stop loss limit and the value at risk limit interact. If you see in front of you, I actually have a lot of data. The first sheet that I want to point out to you is the histogram on this side, on the left hand side of the screen. This histogram is a histogram of the daily returns from my portfolio. If you remember in our value at risk session, we created a portfolio in 6 securities, including positions in the Australian dollar, positions in the Japanese yen, positions in WTI, gold, and natural gas. And this is the return from that specific portfolio. So the piece that I want to point out to you, I think the piece that requires and needs our attention, if I extend this a bit, is the space here. There we go. So if I were to ask you what is the most common, the most likely median return, the answer is this pillar, this bar in the middle. And the most median, the most likely return that you're going to see on a given day or any given day, as far as this data is concerned, is a number between minus 0.25% and about 0.29%. So the first question you need to ask yourself from a stop loss point of view is, where is my stop loss set? Is my stop loss set in such a fashion that I cut a trade, take a loss, move on small variations, or do I take a loss and move on when there is something which is a little more deviant than just normal variation? So you have two choices. You can do take a look at the most median movement, which is, let's say, this part here, or you could say I want to set my thresholds in such a fashion that I don't wait till I actually end up with a 1.87 return, a minus 1.87% return. I actually want to avoid anything beyond this threshold. So my stop loss threshold is about half a percent, minus half a percent here and here. Now, to a large extent, this is also determined and driven by the underlying volatility in your markets. And if you were to simply take this on, this is the histogram of daily return. Right next to, I think we have, there we go. There we go. So this is a, so right next to, just over, I'm just going to put a overlap here so that we can use it. Over here we have a trailing trend of portfolio volatility, and you can see that as far as this portfolio is concerned, vol have been started at a peak of about minus 1.6%, then quickly fell off to about 0.4%, then went up and down between 0.4 and 0.8%. There was a period when they came very close to about 1%, but then they came down again to about, let's say, at the lowest level at about 0.3%. So this is the range of portfolio volatilities. Question is, how does this trend relate to the losses that we see on this side? The objective of a stop loss limit is to not hinder trading, is to not be is to be not an obstruction. The objective of a stop loss limit is to make sure that unusual losses that are likely to eat significantly into capital, are are identified, and positions that are beyond those levels are normally closed and shut down, and those losses are booked, so that we can not lose a larger amount of a capital, but just lose enough so that we can come back and fight and trade another day. So the objective of stop loss limit then is to make sure that you will set it just beyond the median range of, or the median threshold of trading losses that you're likely to see, which is this belt here. Anything beyond this would basically fall. You're saying, there's only about a 20% chance, which is basically a 1 in 5 day trading loss, as long as you assume that your traders are reasonably likelihood. Now, what's going to happen is that these are limits that are set under times of stable volatilities. When portfolio vol or market vol hike, when they rise up, when they go up, you will see this going up and down. And when this goes up, what you want to do is you want to cut this threshold. Again, depending on your point of view, whether you trade vol or or whatever your point of view is, there's a very good chance that as vols go up or hike or spike, you would actually shrink your stop loss threshold, bring it closer together, close the gap, so that there is less of a chance of losing a significant amount because of market volatility. So now, if you're clear about how or why stop loss limits are set, and what's a good way of identifying a threshold for stop loss limits, which in our point of view is the median trading losses that you're likely to see, and we also understand the point that these limits are likely to move up and down depending on market conditions. Let me just move this away. So let me just say cut, and let me bring it down and put it back where I took it from. Paste. There we go. That's the wall is down. So the question that we now have is, as volatilities move up and down, as you see at this specific point in time on the currency side, as vols go up and down, there is a very likely chance that you would actually play around and tinker with these limits also. So how do you link value at risk and stop loss limits? The question, the core question, the key question is what we just said: median likely trading losses. If you now come on the right hand side of the spreadsheet, you'll see that I have actually laid out a couple of tables. The first table is a simple calculator. This table says at 99% confidence level, my Z factor is 2.32. My portfolio volatility based on the VAR spreadsheet that we built earlier is 0.69. My holding period is 10 trading days. My holding period volatility is 2.18. My value at risk at 99 percentile over a 10-day period is about 5.079, right? So this is my worst case loss. My worst case loss is set in such a fashion that there's only 1% chance, as far as my model is concerned, as long as this data set holds in the future, there's only a 1% chance that I am likely to see a loss of over 5.079%. Right? Now, on this side, on the second table on this side, all I've done is I've taken this data set and I've turned this into a data table. And what this data table does for me is it says, okay, for a confidence level of 99.9 percentile, my value at risk estimate is 6.75. At 99 percentile is 5.08, the same value that we had here. At 97.5% is 4.28. At 95% is 3.59. At 90% is 2.80, and so on and so forth. So what this table does for us then is that it says, as you change, as you move the confidence levels from 99.9 percentile to 51 percentile, I will also look at how the VAR number moves. So the VAR number moves, by the time you come to 51 percentile, the VAR number goes from 6.75% to 2.05%. How is this relevant in terms of communication? You go back to what Nassim Taleb had said. If you remember the list of qualifications when Nassim spoke about, he says, when we communicate at these levels, when we say there is only a 0.1% chance that you'll see a loss higher than 6.75%, you're basically telling the board or your directors or your board risk committee there's only one odd out of 999. So one odd of almost out of 1,000 odds that you will see a loss of more than 6.75%, and that by itself immediately discounts this number. People take this number and they simply multiply it. This is what they see. They simply multiply it with this. So in their point, when you say there is only a 0.1% chance that I'm going to lose a number higher than this amount, they read this as a loss of 0.00675%. This is, to them, this is the adjusted number. This is the translated number. You say 6.75% at 99.9 percentile, they read 0.00675%. So they're saying, okay, so the expectation is that we'll lose about half a cent. And, well, that's not a large number. Even though it comes with a large probability and it looks like a large number, but when I translate this, as far as my own readability is concerned, this is not a large number. If you extend this table, now you're getting somewhere, right? So now if you look at these three thresholds, if you look at the number here and here and here, now you're saying I'm talking about a 0.5% loss. So assume that I have a portfolio of, let's say, about $1 million. If I have a portfolio of, in fact, let's make it $100 million to make it a little bit more interesting. Let's assume I'm a large bank. I have a portfolio of $100 million and I'm just having a debate on value at risk. And as part of our debate, I come in and present this result. So I'm saying, all right, Mr. Fareed, there's a 0.1% chance that you lose an amount larger than 6.75%, and when I translate that as Mr. Fareed into this number, I translate that into a dollar amount equivalent to this figure here, about a loss about $7,000. Okay, a large amount for Jawad Ahmad Fareed, but certainly not a large amount for an organization that's dealing in a portfolio of about $100 million. However, at the same time, this is where it gets interesting. However, at the same time, as I move down this threshold, I say 99%. So now you're saying there's a 1% chance that I lose more than 5.0%. This readability, or what the board sees. Let's say what the board hears, right? So you say 99.9 percentile, only 0.1% chance of 6.75, the board hears $6,700. Then you say 1% chance, the board hears $51,000. Then you say 97.5%, or 2.5% chance, the board hears $109,000. By the time you come to 75 percentile, you're saying now there's a one chance in 3. You're saying there's one chance in 3. There's an equal likelihood that over the next 4 days we may actually see this loss, or over the next 2 days we may actually see this loss. These numbers are numbers that actually are taken a lot more seriously. So when Taleb says that he doesn't like value at risk, he says he doesn't like value at risk at this level. He has no issues with you quoting VAR numbers at this threshold, because then you're setting expectations. And if you now look at these, you're saying these are expectations that are set at likelihood. If you look at the odds are simply 1 minus this divided by this. 1 minus this divided by this. As we walk down, you're saying 1 odd in 1,000, 1 odd in 100, 1 odd in 40, 1 odd in 20, 1 odd in 10. So there is, 1 odd in 10. Somewhere over the next 10 days, I may actually lose this amount. 1 odd in 4, somewhere over the next 4 days, I may actually lose this amount. 1 odd in 3, somewhere over the next 3 days, I may actually lose $500,000. 1 odd in 2, somewhere over the next 2 days, I may actually lose, again, just under $500,000. Now this number is a lot more serious. As the board reads and hears and imagines this, they will put a lot more credibility to this figure. What is interesting though is, if you set this threshold at 463 or 66 percentile or a 1:2 odd, the interesting thing is, how does this relate to the median loss? How does this relate to the median volatility? And that's where we come to our next table. So the next table here basically takes the changing walls, the walls that we saw here for our portfolio, just beneath this table here. There we go. These walls that we saw, right? So what I've done is I said, if I go through this entire series, what's the maximum wall that I see? The maximum wall that I see is 1.61%. What's the minimum wall that I see? The minimum wall that I see is about 0.29%. What's the median, the most likely vol that I see? The most common vol that I see is 0.61. And where are these numbers coming from? You can again generate a simple histogram as I've done over here. Bring it over here. So if you generate this simple histogram and overlay it with this series, now you're saying, look, the most likely value that I'm going to see is going to be this number here. It's going to be 0.695, and the number that we have here is also in the same range. So it's going to be between 0.695, between 0.594 and 0.796, and the real number from our calculations from Excel's median function is 0.61. Now, what does this 0.61 correspond to? If I use my var calculator, if in this calculator I substitute the value of, so there you go, this number. If I substitute this number with these numbers, 1.61, 0.29 and 0.61, what are the level of vars that I get? I get 11.81, I get 2.14, I get 4.46. If var was to touch, if vol was to touch its highest level that we've seen recently, our var number would jump from 5.08 to 11.81. If they were to touch the lowest level that we've seen in the past, it'll go from 5.07 to about 2.14. But the most likely number that we are going to work with over the next couple of months, based on the assumption that this data holds, this trend holds in the future, is going to be 0.61, which corresponds to a var of about 4.46. So there are two ways of identifying the median number. There are two ways of identifying the median loss, the median worst case loss, the median threshold. One that we looked at from a stop loss point of view was here, right? A loss of about there we go, about 0.79. Is it 0.79? Can we extend this? There we go. So we have, if I extend this a bit, there we go. So I'm saying here my median threshold is here. This is the number I want to avoid, 0.52. If what is the worst case loss? What is the threshold that corresponds to loss of 0.52? The threshold that corresponds to 0.52 is this number, 1 in 2 day loss. So one way of identifying a median loss is through a histogram of your daily P&L series setting, and the same daily P&L series that you would use for your stop loss calculation, for your stop loss level setting. The second way of doing this is to come through this side. The third way, a more interesting way and just as valid way, is to come from this side. So say, what is the median volatility, and use that median volatility to estimate what should be your median threshold, which comes here. The only problem with using this estimate and this number is that if I use this 2.5%, my board immediately discounts it. Says there's a 1 odd in 40. There's a chance that we'll see something like this happen once in, let's say, month and a half, once in 2 months, and they translate this at a significantly higher level, $100,000, but it's still a lot less than the number that I see here. So with respect to board communication, my preference is that you set, communicate, and calculate value at risk with odds, with translated numbers, keeping in mind what the board will hear. I know, I understand, and I realize that the Basel II document and now the Basel III document would still want you to look at numbers at a higher level of threshold, but that's for regulatory reporting. For your internal consumption, for your internal limit setting, it is far better for you to work with VAR numbers that are driven at these confidence levels, because this is what the board reads. It's not about going in this direction. It's about making sure that you move in a direction that the number that you calculate and communicate to the board is viewed with credibility, is taken seriously, and whatever action is required to do the needful is taken. Whatever authority is required to cut these positions is granted. That will not happen if you're working at this level, but it will certainly happen at this level. Now, the connection between stop loss and value at risk, the primary connection is that once you've identified the median return, which for our case is here, which is about 463, then perhaps you should set your stop loss at this $500,000 threshold. If I use this 0.52 number here and I apply that to my 0.52%, and I apply that, 0.52%, if I apply this to this threshold, you can see that the two median numbers actually match. If I take my median loss, the most likely loss, the threshold that I've set for my most likely loss that I'm likely to see over the next 2 or 3 days, that number is $520,000. That comes from this histogram. If I communicate the median number from my VAR table, that number is about between 460 and 490. So you can see these numbers are actually quite reasonable and quite nearby. So if the stop loss threshold is set at $520,000, you would now need to set your VAR threshold at a slightly higher number, just in case, to ensure that you do not get in the way of normal trading behavior, that you do not become a hindrance or an obstacle or a nuisance. Yes, the objective is to ensure that you do not create or that you avoid unlikely, unnatural, very large extreme losses. However, you can't do that unless and until you understand what is the expected trading behavior for the bank or the treasury desk in question. So I hope this sort of understands, or this sort of helps create and clear the linkage between value at risk and stop loss. Again, a quick review: stop loss limits are set to ensure that we are in a position to cut losses, get out and protect capital. However, we do not do this at every single tick in the market. We create thresholds within that identify normal trading behavior, normal trading losses and gains, and we only incur or exit or trigger a stop loss when those limits are breached. We've also gone out and said and introduced the concept of a median loss. We've also gone out and introduced the concept of what the board hears when we communicate expectations and percentages or confidence levels with respect to value at risk, and what is a much more better and effective measure of communicating our numbers, which is, yes, this number, 66 percentile chance, 33 percentile chance, but also odds, probabilities, and actual expectations with respect to what the board is likely to see. And finally, we made the connection between the number that we've come or generated or calculated from the VAR side and simply linked that number to the median threshold that we've seen here. So now the next piece that comes up is if you're clear about VAR and stop loss and the connection between these two, the next number that comes up is what we call PSR limits or pre-settlement risk limits. And the question is very simple. Let's look at 6 trades. So let's say that I have a position, and as far as this position is concerned, let's say I'm looking at, let's say the principal is about $1 million or equivalent amount in $1 million. Okay, so this is my position. So now I have an equivalent million US dollar equivalent position in the euro, in the Australian dollar, in the Japanese yen, in WTI, the West Texas Intermediate oil blend, in gold, in natural gas, and in the 30-year bond. The question is, I have the trade that I'm working with. The trade is that I have agreed to buy or sell each of these securities from a counterparty, with a counterparty, over the next 10 days. And the question is, while we've agreed to this transaction, so we have 6 transactions. I'm buying euros in the forward market, the Australian dollar in the forward market, the Japanese yen in the forward market, WTI in the forward market, gold in the forward market, natural gas in the forward market, and 30-year bond in the forward market. The question is, what is the settlement risk? 10 days later, if the counterparty defaults, what's the worst that can happen? And how do I answer this question? Now, there are 3 ways of looking at this. The first thing that you can do, that you can work off, is say, okay, I'm going to take the position that I'm going to work off the maximum volatility that I've seen in the last 60, 70, 80, 90, 100 days, and I'm going to work off that assumption. If I work on that assumption, I'm saying my maximum volatility is about 1.59 for the euro, about 2.02 for the Australian dollar, 1.02 for the Japanese yen, 2.89 for WTI, 1.79 for gold, and whoa, it's 7.66% for natural gas and 4.09 for the 30-year bond. If you remember, this is an exercise that we've done in our lesson on value at risk when we calculate value at risk. Let me clean this up. Let me just remove this, put it here, paste. So that's my portfolio walls out of the way, and so there you go. This is the trailing volatilities that we plotted, and this series basically comes off from these trailing volatilities as far as the currencies are concerned. We've done a similar thing with respect to commodities, but that graph is not visible here. Anyhow, so what you're saying is, walls go up, walls come down. What is the maximum wall? The maximum wall, as far as this data set is concerned, which is about 180 days, is 1.59. For the Australian dollar is 2.02. For the yen is 1.02. WTI is 2.89, 1.79 for gold, and 7.66 for natural gas. The minimum volatility, the lower end, is this number. The median, the most likely volatility. If I again go back, this is the portfolio wall series, right? So I'm saying, what is the most likely volatility that I've seen? The most likely vol that I've seen in this threshold is between here and here, which translates into, for at least for my portfolio, translates into 0.61, right? But for euro it's 0.64, for the Australian dollar is 0.72, for the Japanese yen is 0.6, for WTI is 1.58, and so on, right? So now the question is as far as your PSR limit is concerned, which one do you use? Do you use max, min, or median? The safest answer, the easiest answer, the simplest answer is obviously max, right? So if I can get away with max, I'd say your limit utilization for this 10-day transaction for the year is about 11.7%. For the Australian dollar is 14.9%. For the Japanese yen is about 7.5%. For WTI is 21.3%. For gold is 13.2%. For natural gas 7.6%. And for the 30-year bond, it's 30.1%. Now, let's take a look at this. If you're saying max, min, and median, what's the average? So if I were to simply plug in the average, I would need to average. Let me see if I can pluck the average out. The average volatility, as far as our sheet is concerned, is here. That's the average vol, right? So that's Euro, Australian dollar, and JPY. Let's simply click this, Control Insert, JPY. Then WTI is also here. However, gold is right towards the end. So natural gas average vol is here. There you go. That's the average vol. And for gold, it's one less. So let me just do gold, and then we are done. There you go. Now this is the average vol. Now this is the average vol. That's the number that you are likely to see. That's the annualized vol. Sorry, I've taken the wrong numbers. I actually have to take these numbers. I was looking at why this number is wrong. So for these gentlemen, I think we are fine. But for gold, the cell that we're looking for is not 14.9, but this. For natural gas, the number that we're looking for is not 43%, but 2.56, which is here. Let me just check to make sure. If you're wondering where this is sheet coming from, this sheet is the same sheet that we covered in our calculating value at risk course. So 0.74, 0.92, 0.61, and 1.6. And it's 0.74, 0.92, 0.61, 1.6. Alright, so for these guys, you're right. Alright, so now what we're saying is the average vol, if you're using your PSR limit, your pre-settlement risk limit is 0.74, 0.92, 0.61. You compare these to the maximum number that you're seeing here. As far as the euro, the Australian dollar, the Japanese yen, the WTI, gold, and natural gas is concerned. Right? So the question is, how do you calculate PSR? PSR is just like your VAR calculation. What is the worst case movement? What is the most likely movement that you're going to see over the next 10 days? And if the customer defaults at the peak of that movement, that's the amount that you're going to lose. If that's the amount you're going to lose, you need to make sure, you better make sure that as far as this relationship and this client and this transaction is concerned, you have the appropriate credit approvals, you have the appropriate limit allocation, and you have the appropriate margin or collateral requirements in place. But the question that I'm asking is, this calculation, if you're working off traditional methods, working off the methods that we've worked with so far, is worked on average volatility over some time frame. What we're seeing is this volatility is all over the place. It's all over the place here for the portfolio. It's all over the place here for the currencies. And the range that we see here, on the min side, we're saying it's 0.28. On the max side, we're saying it's 1.59. On the median, the most likely was about 0.64. So while the average is certainly more than the median, it's certainly a lot less than the maximum exposure or the maximum hit you could take if volatility suddenly decides to spike tomorrow. So from a PSR point of view, the calculation is fairly simple. The calculation is simply, if I were to trace this, let's go to formula, let's go to trace precedent. The calculation is for maximum, it's simply the vol here and then two figures. And the two figures that we use are hidden by our graph on the histogram. There you go, are the z factor that we're using and the square root of holding period. If you click F2, let me click F2, there we go. If we click F2 here, you can see that I'm using the volatility times the square root of time into the z factor, and that gives you my PSR limit. Now, if I have this PSR limit, I now have limits calculated on three bases: maximum, minimum, and median. And I don't have a problem with working with maximum. My only concern, And my only issue is that this is something that cannot and should not be done on a static basis. This is something that needs to be reviewed based on what's happening on a volatility side. And you'll find that with good risk controls, good risk systems, good risk practitioners in place, these numbers get reviewed on a weekly, monthly, quarterly basis based on what's happening in the market, sometimes as soon as events dictate the need to revise these thresholds. However, if you're not revising these thresholds, if you're still working on, let's say, where vol was at this level and now vol is at this level, you're sitting duck, because your threshold, your margin requirement, your collateral request is for 2.1% of the transaction in the trade. Your actual exposure, if vol is here, is 11.7%. The shortfall is about 5 times. If you look at the ratio, I will simply do one more calculation here, which is this divided by this friend here, it's 5.6 times. And that's just for the euro. If I were to take this onwards across the other categories that we have here, 6 times for the Australian dollar, 4 times for the yen, 4 times for WTI, 4 times for gold, 7 times for natural gas, and 116 times for the 30-year bond. Okay. The same process, just as we worked here on the PSR side, the same process would work for a 30-year bond. However, the volatilities that you see here, the 4.09, the 0.035, the 4.35, are not rate volatilities. We're not linking PSR calculations or margin requirements for fixed income bonds of rates. We're actually linking them to price volatilities. Again, this is a concept that was covered in our earlier course on calculating value at risk for fixed income instruments. So, in conclusion, we've spent the last 15 minutes on quickly reviewing, first of all, the concept of stop loss limits, linking stop loss limits with value at risk, linking stop loss limits with what we call the concept of a median expected likely trading loss, emphasizing the concept that both VAR and stop loss limits are there to ensure that we protect capital, not there to be a nuisance or to get in the way of normal, rational, reasonable trading behavior. Once we did that, we looked at the whole concept of calculating PSR limits or pre-settlement risk limits, and we looked at the primary question, where do PSR limits come from and how do you calculate them? And we spoke about the fact that in general, the practice is the market calculates them of the average. Our suggestion is that you work off the maximum. Even if you don't work off the maximum, even if that's not possible because of competitive pressures, there is still a case to be made for reviewing the underlying volatility that's used to calculate PSR limits as markets react to changing environments. And specifically in times of high volatility, it's important to increase the PSR limit utilization, cut your stop loss thresholds because the median trading loss is going to increase, the band is going to increase, and reduce your VAR limits. That's what's supposed to happen. That's what generally happens. Now there's a big debate on whether this behavior of reducing PSR exposure, increasing your reducing your VAR threshold, and decreasing your stop loss limits, whether this behavior, whether this reaction to volatility actually contributes a much larger share of volatility to the market. So rather than removing volatility, is this actually a cause of volatility? And that's a debate for another day. Thank you very much for your time. I hope you've enjoyed this session and this has been useful. My name is Jawad Ahmed Fareed and I'm signing off for financetradingcourse.com.